Robschild. No investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and crystal ball gazing. Today is Wednesday, November 27th, 2024. Today's episode, we're going to start by talking about the initial jobless claims and PCE data that came out today, Wednesday. Heading over to marketwatch.com, initial jobless claims came out not super high. I do find it suspicious that in that report they revised the previous week's initial jobless claims up 2,000 more. I mean, small amounts, still overall pretty low numbers, at least according to what they're reporting. The other notable data coming out today, the GDP first revision. Sometimes this, can get revised higher or lower. If it gets revised lower, that can be a signal like, okay, another signal that things may be slowing down soon. Instead, we're staying at 2.8 GDP growth for quarter three of 2024. And then we have the PCE data came in completely flat, same as last month, same as expected. Again, the column over here is actual, the middle was the expected number, and the right column was the last reading of this. So the PCE index, month over month, rising only 0.2%, year over year, expected at 2.3%, and came out that way. The PCE index being personal consumption expenditures. This is the Fed's favorite spot to check where inflation is. That's what they say. And then even better is the core when you take out volatile food and energy, and completely flat here. So nothing to surprise markets unless markets were expecting a surprise, I guess. I also wanted to mention market hours for the rest of this week, obviously, because of the Thanksgiving holiday tomorrow. Markets are closed, and then we have shortened hours on Friday. I believe the stock markets are open until 1, and the bond markets open until 2. So, sort of a normal day, except the fact that, most of the pros are sleeping. The cats are away and the mice will play for sure. Before we get on to the charts, the daily reminders they're still the same. If you want to see me read through these items and explain them, watch Monday's show, 11:25. It's the one with the tree and lightning in the picture. These daily reminders are all things that are very easy to forget, but are all too important for any serious active investor or trader. With no updates in the daily reminders, the crystal ball readings remain that the S&P 500 is currently priced like it's a Ponzi scheme, not relying on any kind of safe valuation, but having so much speculative value that it is only functioning in a way that is hoping that tomorrow someone will pay a higher price than what someone paid today for it. That's the only thing giving it value. It's just a hope and a prayer. The crystal ball reading also remains that the bear market is imminent. There's a bear market coming very soon, and that the Fed won't cut fast enough to save the economy. And even if they try to cut fast enough to save the economy because of the amount of fiscal debt, the cuts won't be as effective as everybody is kind of assuming. Remember how the hiking cycle didn't slow down inflation? Well, guess what happens on the other side of the coin? On to the charts, starting with the SPX, the S&P 500, playing around again with all-time highs. Not really anything to see here, folks, especially considering that the professionals aren't going to wake up really until Monday. Next week, we'll see what's really going on. If we're really maybe headed a little higher in the S&P 500, or even much higher in the S&P 500, or if this might be the ultimate top. We'll see. The dollar DXY finally is not looking bullish anymore. We're going sideways, and I'm not sure if this means we're headed lower in the dollar for the moment, or if we're going to consolidate and head higher. No idea, but it broke lower. We're no longer just going up and up and up like we had been for since what is this? The end of September, just ripping higher. This is no longer ripping higher. TLT, my favorite place to be. I have something like 56 or 57% of my own portfolio exposed to long duration treasury bonds. We went up by 0.7%, going above this previous sort of resistance line. I had been counting this as a descending broadening wedge. Some other traders that I recently listened to recently noted that there's this triangle. They call this a diamond pattern, which is similar to a descending broadening wedge, and it obviously broke out to the upside, and then we got some more follow through today. So if you've been watching the show, I had been predicting with pretty strong conviction that this would be headed higher, especially on the back of the RSI divergence between the price and the RSI. We had lower highs and lower lows in the price at the same time, higher lows and higher highs in the RSI, suggesting that big smart money is like manipulating the market so that the price is low, and they're just gobbling it all up as fast as they can. And yeah, just another reminder on all of U.S. treasuries, compared to other world currencies. The U.S. dollar is currently, yielding one of the highest. It's one of the highest. It probably is the highest yielding major currency that's out there. It's it's one of the more attractive places to be in the from a global perspective, and so I'm not surprised to see money loading into here. I mean, if you try to get treasuries in China, they're yielding almost nothing. With a 4+% return guaranteed on the U.S. dollar. I mean, come on. I've said it a million times, but the other main thing is the S&P 500 having a CAPE ratio of 38 and a PE ratio of 31 right now, all while bond yields are over 4%. That's a major mismatch, and so it just makes total sense for this to be going higher. One of the other reasons I continue to hold long duration treasury bonds is because we haven't gotten to that flushing part of the cycle. We haven't. Credit spreads are actually extremely tight right now. Once they unwind, once stocks sell off, once we get credit spreads widening and asset prices dropping, money will be pouring into long duration treasury bonds, as it does every single time in every business cycle, pretty much ever. So that's what I'm waiting for as my place to exit. And at that time, typically junk bonds are dirt cheap, and that's the time to get junk bonds, by the way. One thing I want to stick in here in the video for today is just to mention that Ben Graham doesn't advise exactly waiting for junk bonds to lose a ton of value and then buy them. He also says never try to predict interest rates. You can't tell if the tide's going in or out. And that's where my macro views come into play, and also the relation of valuations between markets, which Graham I think would say are fairly valid. Graham does, however, say that junk bonds often get to the point where they're massively discounted, as you can see throughout history. And that's the appropriate time to be buying junk bonds, not right now when credit spreads are historically tight, which money is loading into these things like no tomorrow, and I'm still shorting them. I have long dated puts on HYG. Next, TNX, the upside down of TLT, in a way. This is shorter duration, but close enough. This is the most watched yield, maybe even on the planet, the 10-year Treasury note. Again, from the top of 2021, hitting these two bottom points here, forming a head and shoulders top. We broke the neckline. We've been testing it for about a week, and I've been saying, I think this is rolling over. I think this is going down. I said it every single one of these candles. I said the same thing, and apparently I should have gotten even more leverage on the conviction of that. Treasury yields are clearly breaking down. From a chart standpoint. By the way, the target of this Head and Shoulders top, if you take the top, drop it to the neckline, and then go to the breakout, the target here is a yield of 2.83. I will be probably exiting most of, if we get there. I mean, by the way, if we all the chart patterns are saying that there's like a big black swan event coming. The yields are like front running it. It's like it's amazing how charts can do that accurately often. And so with me and my crystal ball, I feel like it's literally playing out as like right now. I'm sort of under the assumption that we're not going to get all the way down to 2.8% in the 10-year unless it's very clear that there's the economy has slowed down significantly, that the Fed has choked the economy for long enough for there to be evidence piling up in the domino effect of banks blowing up, people losing their jobs en masse, and no one knowing what to do. Another little thought I wanted to pop in here was that, a lot of the time the market needs to sort of wait for everyone to believe that the soft landing has been achieved and everything's going to be peachy and everything's going to be perfectly fine. So I guess I better say that, put that out there into the world. Yeah, we've achieved a soft landing, everybody. Everything's going to be perfectly fine. Everyone will be rich very soon with all of their meme stocks and meme coins, and everything that they bought are just going to keep going up in price, and everyone's going to be fabulously wealthy. I mentioned yesterday that the 10-year break-even inflation rate, probably the best guide that we have as to what may happen to, in inflation. What is the market pricing inflation will be on average over the next 10 years? As I've been saying in many previous shows, we had been going flat for a very long time. I mean, this was from November 7th until the 22nd. That's almost a month. 2 weeks, something like that. We had been going completely sideways without budging. And then I've been saying on the show, I would expect it to crack to the downside. It did crack to the downside, and we've been falling ever since. Today, going lower here, a low not seen for quite a while at 2.26%. We haven't seen that since, let's see here, it would have been the beginning of October. So it looks like this consolidation going sideways is resolving to the downside, as I expected, as I said on the show a million times, as I saw in my crystal ball. I've been getting a lot of calls right lately. I gotta give myself a little bit of kudos, a little pat on the back for this one. Bitcoin bouncing today, back up to, as of right now, $96,480. 2 days ago we had this red candle and looking like we might have a bear flag developing, and we popped back up. So it's more neutral than it is anything. I have no idea where it'll go from here, but again, it's sure fun to watch. I've been bringing it up a lot lately. Price of crude oil continuing to just be within this wedge, hitting this bottom trend line here over and over and over again. This line going all the way back to 2021. Some professional chartists are saying that, if we break to the downside, this is it. This is the oil market screaming disinflation, deflation. We're here. It's happening. When the price of oil drops, the prices of everything drops. A lot of the price of what you pay for goods, for example, is completely connected to the price of oil, whether it be beef, food, whatever, and so, combine this. Part of what's going on with the oil market is the expectation of the U.S. to increase its oil production, apparently, giving it more resilience. Something Gareth Holloway on his show today mentioned on Verified Investing. If you don't follow him, he's an amazing chartist. I love watching. I love his work. He said when he started trading, it was in the era where the U.S. was not making its own oil, and therefore it wasn't immune to oil shocks coming from the Middle East. If there were wars or things popping up in the Middle East, that's part of what spiked inflation several times throughout U.S. history. And now that the U.S. has been producing more of its oil and assumed to be doing even more of that in the foreseeable future, there's nothing that can really cause the oil market to shoot upwards at this time. And so, with this chart pattern suggesting we're just knocking on this door, on this bottom line here, 1, 2, 3, 4, it's just like a bouncy ball getting ready to roll and then fall off the table, the way I see it. It seems just blatantly obvious to me that things are about to slow down massively here. Again, like I've been talking about on other shows, a similar sort of setup happening in copper with this ginormous head and shoulders top just bumping along on this line here. And if we crack to the downside, it has an extremely high probability of going much lower in copper. Also in silver, a head and shoulders looking formation, looking ready to break to the downside. And even gold, I brought up gold yesterday, and I said, after a big red candle like this, when you have little candles forming at the bottom of this candle here, this is very, very bearish looking. This means that, if there was strength in this market, a break like this, the buyers would be jumping in and buying up as much as they can, sending the price right back up to the top of the candle. We don't have that. We have 2 days now of consolidation at the bottom of this red candle. There's no other way to put it. Gold looks bearish here. I've been bringing up the semiconductor industry a lot lately, talking about how eventually this industry won't have ginormous companies with PE ratios between 50 and 70, but as low as 10 or even lower than that. Once you have enough production, there's competition of price and people don't need them as much anymore. And they're commodity producers. They're not making iPhones. They're not making Nike shoes. So from a valuation perspective, this market, it got really expensive. And, these companies have been making lots of money. The AI thing has been taking off like crazy. Little thing I want to slip in here again, all these pictures that you're seeing on my own YouTube channel, I'm not paying a penny. I'm not even getting ads. The price of AI seems extremely cheap to me. It has to be. If I'm already getting free access to what seems like to be very powerful tools, like with ChatGPT and all of that, where's the money to be made? I'm not paying anyone any money for it, and I'm using it like every hour of every day now. But anyway, that's a whole nother discussion, because the semiconductor industry, they're part of the supply chain basically of AI. They're not AI themselves. But anyway, this head and shoulders with all these really large, formidable red candles. The most previous one, again, being October 15th. We have head and shoulders here. We have a rising wedge breaking down here. We have this giant head and shoulders here with a purple line. Today, it went further down. If you're like me and short semiconductors still, I have the fund SOXS. You're feeling fairly good about that choice at this moment still. I don't mind speculating in this, as I've been saying in the show. When I can see clearly overvaluation in an entire industry, and I see patterns like this developing, I can't watch it go down and not make profits off of it. Can't do it. Can't sit on my hands for this one. Not this time. We'll see if I end up regretting it or not. I mean, I guess I already took some profits. Took a good amount of profits actually already. And then the worst that can happen is I lose the gains that have already been made into the price of SOXS now. Like, and then I could get out breaking even if SMH somehow just like skyrockets back up. I don't expect it to. With me and my crystal ball, yeah. But yeah, Mr. Market, he's a crazy guy. He can do anything he wants. We'll see what he decides to do here. And that's all for me and my crystal ball. Hope you enjoyed. Thank you for watching. Have a great Thanksgiving. And I am planning to do a show on Friday, even though there's shorter hours. And that's it. I guess, well, one other thing. I finally finished the series, The Intelligent Investor. Finally finished. There's a series on my channel that goes over every single chapter of that book. I also have a series that went over all of the chapters of security analysis, and I'm considering redoing that entire series to really, have the entire brain of Graham in my head. Getting through those books was a good amount of work, and I finally finished it. So it's just another little milestone that I reached today. So it's kind of fun. But anyway, that's all. Yeah, that's all from me and my crystal ball. Hope you enjoyed. Thanks for watching. See you next time, Robschild.